And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, joined today by John Davi of Astoria Portfolio Advisors and Todd Rosenbluth of CFRA. The NASDAQ Composite exiting correction territory today as we await Alphabet earnings after the bell. Alphabet is a major component of the NASDAQ. Its Class A and its Class C shares make up a combined total of more than 8% of the QQQ NASDAQ 100 tracking ETF. But it's also one of the biggest components in the communications sector. Check this out. Alphabet makes up nearly 24%, a quarter of the XLC Communications ETF, followed by Facebook, which is also there, pretty big at 17%, Netflix at 6%. So what ETFs should you use to trade Alphabet, Todd? It is amazing to me I approve of market cap weighted ETFs, but when you get these giants that come in, like your Netflix and your Alphabet, and they dominate it this way, it's very important to understand what you're owning. You're buying an ETF, a quarter is one stock, and 45% essentially is three stocks.
Right, so the communication services sector basically took over what used to be the telecom services sector in the S&P 500 that was dominated by AT&T and Verizon. What you've essentially swapped out if you owned VOX, which is the Vanguard Telecom, or it used to be the Vanguard Telecom ETF, which is now the Vanguard Communications ETF, is you now have a heavy load of Alphabet and Facebook and Netflix, more of these FANG stocks, more growth-oriented stocks you'd find in the QQQs, not the dividend-paying stocks that are normally known as telecom ones.
Right. And John, you specialize in advising clients on the right ETFs to pick. There's nothing inherently wrong with market cap weighted. It's a great thing when you've got FANG stocks moving up and you've got a big market cap weighted in FANG stocks. But when you move to the downside, all of a sudden, these could dramatically underperform. These are momentum names, by and large. And so how do you address that? I mean, do you advise clients buy when the momentum's with you and sell when it's not with you? What do you tell people about when you get these kind of awkward weightings, I guess you call them?
I think if you're trying to capture the risk characteristics of FANG stocks, which are momentum-driven stocks, in my opinion, I would probably use something a little bit more diversified, something like MTUM, which is the momentum ETF. So if you take XLC, basically 46% of the MTUM is from the XLC ETF. So it's another way to get exposure to that theme, and you have a lot more diversification benefits.
Right,
so,
but here, if you buy the MTUM, you're buying momentum names in general. These are stocks that are exhibiting above normal price differentiation over a small period of time. They're not necessarily communication stocks. Or
correct,
stocks
but there's a
that
lot of the stocks that are in the communication ETF are also in the MTUM. So, I mean, since XLC's been around since July, it's down 10%. The MTUM is only down 3%. So it's a way to kind of get a little bit more diversification and protect the downside.
But what you find also so MTUM rebalances every 6 months. So instead of always having Alphabet and Facebook and Netflix, it'll rotate and added some healthcare exposure later on in the year, became a little bit more defensive. So you need to really look inside the portfolio on an ongoing basis, not just assume you know what's inside.
But the important thing here is this communication ETF is going to move on the earnings report tonight, and people need to be aware of that. So I put up the sectors every morning at 9:40 when the market opens, and if this is going to be down 3%, it'll be because Alphabet is going to be down 3%.
Right, but it benefited. So Facebook was up last week after what was believed to be strong results. We at CFRA agreed with that, and the stock continued to move higher. That helped XLC. Yeah. If Alphabet disappoints, we hope it doesn't, and we don't think it will, then you'll obviously see the negative impact of that.
Final thought here on this sector. People will often write to me and say, well, the ETF that holds the biggest amount of actual Alphabet shares is the SPY, or the S&P 500. I think that's true, but not interesting. Would you agree that doesn't really matter that much? They have the most amount of shares because they're the biggest ETF that's out there. That's not what we're looking for. We're looking for what influences the ETF, and obviously here it's the communication sector one that really would be moved by Alphabet's presence.
Right, so the stock tends to move what's inside the ETF and makes the ETF go up or down, as opposed to these ETFs are moving the stocks.
Right.
So how much total share counts it owns is less important.
It's the tail wagging the dog here. Let's move on. We're going to turn our attention to China. As trade talks are now underway, emerging markets in China have been breaking out. The FXI, which is the biggest China ETF, and China-heavy EEM, both up around 10% this year. Now, for more on this, let's bring in Brendan Ahearn. He's the Chief Investment Officer at Crane Shares, who also runs his own ETFs. And one of the things, of course, we do here, Brendan, is educate people about the differences in these ETFs. So, for example, the FXI, which is the largest China ETF out there, only holds shares in Hong Kong. Those are heavily weighted towards some of the big bank shares, for example. You have an ETF that essentially exists to invest in internet names that will hold names that are not only in Hong Kong, they're on the mainland, they're here in the United States, for example, and it's a different way of looking at things. How should an investor who wants to put money in China look at these? That's what we're trying to educate people about.
Yeah, I mean, I think you have to do your ETF due diligence. That's the size of the fund, the trading volumes, the expense ratios, but also the exposures. FXI, very large ETF. 2/3 of the exposures in Chinese banks. That's a big bet on mega cap, large cap Chinese banks listed in Hong Kong. At the same time, at Crane Shares, we're very much focused on the domestic consumption story. Over the weekend, Caixin Services PMI, 53.6. So you're seeing the consumer in China is alive and well, and KWeb is really built to hold those companies that are the transmission engines for domestic consumption as it takes place online.
And yet what we saw last year, as I follow this very carefully, is there wasn't a lot of differentiation. China did not have a very good year. The S&P 500 outperformed. We were down, what, 5% on the S&P 500. But most of the China ETFs were down 20% or so here. Here's a list of them. There's the FXI, and there's the MSCI China. KWEB, or China Internet One that you represent, was down 30%. They were all down pretty significantly.
I mean, universally, if an ETF had China in the name or a Chinese stock, it got taken out to the woodshed. But what we saw in 2017, Bob, was a very large dispersion. KWeb went up almost 70%, which is almost twice the rate of other large China ETFs.
Yeah, it comes down to whether or not you want to have technology within your portfolio. So this obviously is a dedicated ETF focused on the technology space, but also it includes companies like Alibaba and Baidu that are U.S. listed stocks, but that are obviously dependent upon Chinese economic growth. FXI does not provide that. You had MCHI, which is another iShares ETF on the list. That'll include some of those U.S. listed stocks, but be more broadly diversified across the sector landscape.
I think people need to understand, of course, that with some of these, some of the biggest Chinese companies like Alibaba, JD.com, are listed here in the United States, and they're not on some of these ETFs. That's very important to understand them. John, where does China fit into a global portfolio? You advise people on where to
I think
put money.
You have to look at China. I mean, it's one of the only economies globally that's actually injecting liquidity into the system, right? So you think about what the Fed's doing, ECB, they're taking liquidity out, right? So I think all of emerging markets are pretty cheap at this point. Right. China is a big part of emerging markets. We tend to like MCHI a little bit more in KWEB. You kind of get the broader Chinese market. I mean, KWEB is like 30 times earnings. MCHI is more like 11, 12. MCHI, you got like, double gross margins, high ROE. So relative to like the risk in the portfolio, I think we would use something like MCHI.
Brendan, what about the emerging markets right now? I mean, right now, one of the problems I have with the U.S. market is it's kind of pricey. We're at 16 to 17 times forward earnings. It kind of depends on how you look at it. But the emerging markets in general is cheaper. Can you make an argument? I know you're in the emerging market business, so I don't want to put you on the spot, but can you make an argument why emerging markets should be an outperformer this year? It hasn't for a while.
It's both historic as well as relative valuations versus the U.S. market and the EM indices valuation on a historical basis. I think also if we had the Fed on pause, that could maybe tamper the dollar rally, which has been a big headwind, as well as we're starting to see commodities firm. I think what's important is, as investors in broad-based emerging markets, you have 25% of the exposure in financials, as well as an additional 15 to 20% geared to commodities. So at Crane Shares, we're very focused on capturing these domestic consumption names like we do with KWeb, and we have a fund called KEMQ that captures the EM consumer in internet and e-commerce for broad-based emerging markets.
One of the reasons that the multiple is higher is you have an internet stock.
Yes.
So the multiple is going to be a little bit higher.
Yeah. I mean, Alibaba just grew revenue 41%. As an investor, we have to pay up to capture that high rate of growth.
Yeah, and you own, of course, Alibaba, which trades here in the in the U.S. and another fund, right?
We do. We do hold Alibaba. We think it's a great company. At the same time, that China internet and e-commerce ecosystem is much more diverse, and it's something that we're seeing happen elsewhere in broad-based emerging markets. Mercado Libre in Argentina, Cielo in Brazil. This is a global phenomenon that domestic consumption is taking place online.
Okay,
if you look at year to date, though, KWeb is up 15, MChai is up 12, so you kind of get the upside exposure with MChai. Whereas last year, according to your stat, KWeb was down 30, MChai was only down 18, so you kind of capture some of those risk characteristics in MChai.
For sure, I think the heavy financial weight in MChai at over 30% kind of tethers it a little bit, provides a little bit more of the valuation. At the same time, even MChai has 29% to Alibaba and Tencent alone. So it is still a little bit of an interesting basket.
Okay, Brendan, thanks very much for joining us. Very stimulating discussion there. And again, it goes down to know what you own in these ETFs. Time now for a little myth busting, where we dig into common misconceptions about ETFs. Today we're looking at the notion, this is an old hoary chestnut, that the oldest and the biggest ETFs are the best. Todd, you disagree? Make a point about this?
Yeah, I mean, well, the one you just discussed about FXI was the oldest, and there's obviously newer products that are out there. You could look at Japan, for example. iShares has an MSCI Japan product, EWJ. It's gotten,
and that's market cap.
And that's a market cap weighted product. Most of the products that are dedicated to Japan are focused on a cap weighted basis, but we've seen price competition taking place. So JP Morgan launched a suite of single country oriented products. BBJP is a cheaper version of that, similar exposure at half the price. So you can get, and it's now a $3 billion ETF as it continues to see inflows. So that's one example. We've got the quality theme, which is popular these days. That's a fund that comes from iShares on the quality factor. We've seen some newer products that have come out. One that we're going to talk about at the Inside ETF conference is QARP, which is a DWS product that takes quality, focuses on that, but then also looks at undervalued quality stocks, so blue chips at a reasonable price.
When you say quality, I want to make it clear, generally you're talking about companies where their earnings are growing, for example. Would that's a typical aspect of what you call quality.
These are companies that have consistent earnings growth, that tend to have below average debt leverage, that have strong balance sheets, strong cash flow in that regard as well. But now in this new ETF, you can be able to pay a lower price.
John, just quickly, the idea that the first one out there gets all the assets may be true, but again, it doesn't necessarily mean that's the one to invest in.
Correct. I mean, I think you want to load your ETF into like a quantitative portfolio construction tool, look at the underlying, stocks, aggregate up at the index level to see what the fundamentals are, what the risk characteristics are. You can't just go with, the assets under management or, the liquidity.
Well, let's talk about a potential portfolio, because one of the things we like to do is ask our participants to construct portfolios for us. Now, Todd, you brought along a model ETF portfolio for us. Break it down. You've got an equity component here, and you've got a bond / cash component as well. So let's just take a quick look at the bond component and the stock component of this right now. And tell us what you got weighted here. Your number one weighting, of course, is the United States here.
Right. So we're favoring U.S. So like you would expect, a home bias. We're favoring large cap U.S. equities. GSLC, which is a Goldman Sachs multi-factor.
You have 40% here in domestic equities in your initial breakdown. Here is your core holding. This is active beta. So this is not an S&P 500, but Goldman Sachs is weighting big cap U.S. stocks in what manner? What's important?
So it's including some of the main factors, so quality and valuation and momentum and low volatility. Those are the four factors that are used. So it's a twist on the S&P 500 index. It's 9 basis points, so it's the same price you pay for SPY. It actually outperforms SPY in 2018. And what we also think is worth doing, the rest of our U.S. equity, is we think with ETFs you can really do a great job of picking themes and sectors and industries. And so we're highlighting a couple of those. A transportation ETF.
Transportation, yeah. So here you essentially own the transportation index, the S&P transportation index.
You are. So this is an equally weighted product. So you'll have UPS and FedEx within. You'll have some airlines, but you're going to have some small cap companies.
And just 10 seconds. Why are you recommending transports as an overweight?
Yeah. So we think that transportation stocks are going to do well in 2019. Our analysts at CFRA are bullish on those stocks, and that's how we at CFRA are picking ETFs.
Oil and gas, IEO. This is another one. The very, very specific subsector of the energy group overall.
Right. So this is a narrower slice of our suggested U.S. equity exposure. We've seen obviously oil recover in recent weeks. and we think this is a good way of being able to play that through some of the larger cap companies within that industry.
And just to finish this down, John, I want to get your thoughts on international equity. You've got 15% in essentially Pacific Stock Index ETF Vanguards.
Right. So we've chosen this Vanguard product. So this is not a EFA-based strategy. We're suggesting we're more concerned about what's going on in Europe. We think that the Asian markets are likely to perform better.
You're excluding Europe.
So this is excluding Europe in this. You can obviously be tactical with that as well as have emerging market exposure.
I want to show up, John, I want to get your thoughts, though, on equities. I want to show briefly the bond market portfolio, but in terms of the weighting, what are you advising clients globally now?
Yeah, so we think of things a little bit different from what Todd is suggesting. I think you want to kind of temper the risk in your portfolio. So we're advocating much more of a defensive posture. We want higher quality stocks in the portfolio, companies that have consistently beat their earnings. We think they're going to be rewarded.
Well, when you say more defensive, you mean in terms of the weighting in the equities? So he's got a fairly significant U.S. weighting of 40%. Would you weight it less than that?
I would overweight emerging markets. That's our highest conviction kind of idea, for this year. So going back to what we talked about before with Brendan, you've got lower rates, a weaker dollar, you've got a much more patient Fed, and then with emerging markets, there's certain stocks in the EM value space trading at 9 times earnings, right? So we're using EMMF. It's a WisdomTree emerging market multi-factor ETF. It also combines, value, quality, momentum. So, we just like multi-factor ETFs because the research shows you can get higher up on the efficient frontier.
We haven't gone into this in a lot of detail, and I've discussed multi-factor for years, but is there any long-term evidence that multi-factor really outperforms just simple market cap weighting, that weighting it in a different way than market capitalization?
I mean, there's tons of academic research and literature and books that I've written. We can discuss, I can send it, to listeners and followers afterwards, but yes, it is. I mean, that's why there's products that are available for you.
Todd, I just want to also note that you also have some weighting in bonds as well.
Correct.
Here, investment grade, intermediate corporate bond, Vanguards, and a high yield fund as well. It's interesting to see, we've seen people recommend against high yield funds this year. I don't know why. They're clipping a coupon at 6%, and if you don't sell, you're still clipping a coupon at 6%.
Right. And
I don't hate high yield.
Right, so there's a risk-on environment that's happening as the Fed is on pause. We think this low-cost product from DWS, HYLB, is a good way of doing it. We at CFRA rate hundreds and thousands of ETFs, and these are some of our best ideas.
And again, you can see all of this. We put these portfolios up on our website, so feel free to go in and look at them in a little more detail. Gentlemen, thanks very much. A pleasure talking with you. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to John, Todd, and Brendan for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, 1 p.m. Eastern Time. Have a good week.